And the Russian ruble is facing new pressure as U.S. sanctions on Russian oil giants Rosneft and Lukoil take effect soon. These penalties strike at the heart of Russia's foreign currency earnings and could reshape the country's economic outlook. With Rosneft and Lukoil responsible for up to 35% of Russia's foreign currency sales, analysts warn the impact could ripple across the ruble, oil markets, and Kremlin's budget. Now, the new U.S. sanctions block all transactions with Rosneft and Lukoil, the two biggest players in Russia's oil sector. Lukoil has been given a deadline to sell all international assets by December 13th, and Washington is warning that any company buying Russian oil could also face penalties. Ahead of the sanctions taking effect, the ruble briefly strengthened, buoyed by reports of a U.S. drafted plan that could end the war in Ukraine, potentially halting sanctions together. But many analysts agree once restrictions hit, pressure on the ruble is inevitable. Russia's currency market has already taken heavy blows over the past year. The U.S. sanctioned the Moscow exchange in June, halting all trade in dollars and euros. Since then, the Chinese yuan has become the dominant foreign currency, with Western currencies traded only over the counter. In 2024, the ruble fell 37% against the dollar, but in early 2025, it rebounded 45%, driven by interest rate hikes and hopes for peace talks pushed forward by U.S. President Donald Trump. Despite predictions that the ruble is overvalued, many economists see its fair level closer to 100 rubles per dollar. The currency has stayed unexpectedly stable in the second half of 2025, thanks to Russia's low rate cuts. Now, central bank forced interventions, weak imports, and the push for import substitution. But now, with up to 35% of foreign forex sales tied to Rosneft and Lukoil potentially disappearing, analysts expect a 10 to 20% decline in overall foreign currency sales in early December. The central bank, which accounts for around 10% of the market, has been selling yuan throughout the year, but traders expect those sales to shrink in 2026. What happens next may depend heavily on China and India, which buy 85% of Russia's oil, as officials do say that refiners in both the countries are cautious and risk-averse. Now, they're aware that violating sanctions could impose them to American penalties. Their reaction will determine how Russia's oil revenues fell. For Russia's budget, the hit could be sharp. Moscow's taxes oil production, not export, but falling export prices matter. In November, the ruble price of Russian oil used for tax calculations was 24% below budget estimates. Already, oil and gas revenues are down 21% year on year, and 2025's biggest predicts another 21% drop. A weaker ruble could help Moscow on paper by boosting ruble-denominated tax revenues. With sanctions tightening, oil discounts widening, and buyers growing wary, the economic path ahead of Russia is becoming increasingly predictable.